In this video on efficiency and behavioral finance, we're going to switch gears a little bit and talk about some tools that might be effective if the markets are not efficient. So what we're going to be talking about is a concept called technical analysis. This is where we search for information. Excuse me. We search for information and prices and returns, and we expect those practices or those patterns, if you will, to repeat themselves. So if you see a pattern, you can then predict what's coming in the future if that pattern indeed continues. So it is kind of controversial. It primarily looks at price movements, and there's some mixed evidence as to whether or not this weak form of efficient market hypothesis is really true, right? Can you earn excess returns by using this price information? So the first thing we'll talk about is just measuring the market itself. So technical analysts argue that there are internal factors, things inside the market that are relevant and predictable and have trends. So we're going to be looking at things like trading volume and price movements that can help us reveal what might happen in the future. So they use then charts or market statistics in order to make these predictions. So the first measurement we have is something called the confidence index. And it tries to predict changes in the stock market by looking at the bond market. Well, what what do those two things have to do with each other? Well, there is a connection. If your money is not going into the stock market, it must be going into the bond market, and vice versa. So if we can see something happening in the bond market, the opposite must be true in the stock market. So if you look at this, we have the average yield of a 10-year high-grade corporate bonds divided by the average yield of a 10-year intermediate grade bonds. So a rise in this index is interpreted as a positive sign for future stock returns. So if the returns are going up for high-grade investments in bonds, that means that the prices of bonds are going down. So that means that money is coming out of the bond market and is going somewhere. It's going into the stock market. So a rise in yield, as we mentioned here, means it's a reduction in price. And again, as I mentioned, that means bonds are money's leaving bonds and is moving into the stock market. So this confidence index, again, as we were just mentioning here, is is what was referred to as a smart money trend, right? In other words, this says that the bond market, in this case, the movement in there, that activity is being driven by investors who are knowledgeable, so that a change in this direction means that there are people who are in the business of understanding and knowing when things are going to happen. This is a change that reflects their decisions, which ultimately then we are predicting what happens in the future to this other market. Now, market volume obviously is a reflection of how investors are thinking. So increasing volume when the stock market is rising is a positive sign, right? So stock prices are going up, but they're going up because people are investing. That obviously means people are putting more money into the stock market. When stocks have been moving up and volume is trending down, that might be a signal of an end of the bull market. And again, this statistic is pretty easy to track over time because it's reported on a daily basis. If we want to think about the breadth of the market, right, the number of stocks that are in the market that are moving, well, in this case, we're looking at stocks that are moving up compared to stocks that are moving down, advances versus declines. So this reflects an underlying sentiment of investors. The market is strong when the advances are greater than the declines, and of course, vice versa. So again, this is all widely available. You can see this every day. It's reported in the newspaper. So here we see for the New York Stock Exchange on this date, there were 92 advancing issues versus excuse me, 2,200 declining issues. So we would say what? That declining issues are gaining over the advancing issues. So this might be a sign that the market is moving down. And if you go across the board, you see it doesn't matter which market you're looking at, they're all showing this advanced decline relationship. We also are seeing that the higher volume is also being associated with declining issues. So not only is this an indication that the market might be going down, but is also verified by the change in volume. Short interest is the number of shares of stock that are short sold in market at any one time. So the more stocks that are short sold, the higher the short interest. So what could this possibly mean? Well, if you're short selling the stock, the implication is that someday you're going to have to buy that stock back. So if short interest is increasing, that means in the future the demand for the stock is going to go up. And of course, this guarantees that the future stock is going to be bought in order to cover these short positions. It also is a measure of the market optimism or pessimism. A weak market is when short sales are high. Again, people are pessimistic about the future, so that means they're short selling. So again, this is information about, well, who does these kinds of things? Who short sells stocks? Typically, it's not people, the average person. Typically, these are more seasoned investment professionals. Now, odd lot trading is something that's driven by small traders, right? People that buy less than 100 shares in a round lot. So this is what's referred to as a theory of contrary opinion. And the idea here is that most investors are always wrong. So if you see what small investors are doing, the opposite is probably true. So again, they panic and sell when markets are low, and they speculate and buy when the market is high. That's the absolute wrong time to be doing those things. So if there's a significant difference between odd lot purchases and sales, again, this could be a signal of either a bear or a bull market. Now, so what do we do with these measures, right? These are all measures in general about what we think, or a prediction of what we think is going to happen in the stock market. We also can maybe apply some of these technical rules to actual stocks themselves. So we want to develop some trading rules. So essentially, investors or analysts are going to look at 3 or 4 of these measures, if you will, to try to determine whether or not they want to make a particular trade. So they may look at something called the advanced decline line. This is the difference between stocks closing higher and stocks trading lower. Again, the difference is plotted. So if the graph is rising, that means advancing issues are dominating, right? Then we're going to conclude that more people are buying than selling. So that must mean the stock market is strong. And again, we would see this as a sign to either buy or sell stocks, depending on whether the line was upwards moving or downward moving. New highs, new lows, right? This measures the difference between stocks that reached a 52-week high and stocks at a 52-week low. So a 10-day moving average is plotted of this difference. We would use this again as a signal to buy or sell stocks. So the market is slow when the market is strong when the highs outnumber the lows, and of course, vice versa. Again, these are all measures, if you will, of what we can do or signals to make trades in the market. The ARMS index is actually something that I've seen published and talked about fairly frequently. Essentially, this is a formula, right? So you take the ratio of the number of up stocks divided by the down stocks, and you multiply that by the quotient of the volume of up stocks divided by the down stocks. Have a spelling error there. So a strong market is going to be characterized, right, by more stocks rising than falling, and when volume is greater than not. So a high trend value here is a signal, right? High trend values are signals that there might be a weak market present. Another number we can look at is something called the mutual fund cash ratio. Again, when do mutual funds want to have lots of cash? They want to keep cash, especially if they think that there is a potential that the market is going to turn around. So we have a ratio of how much cash is in a mutual fund divided by total asset under management. The higher the cash ratio, the stronger the market. And again, the reason for this is high cash positions provide liquidity for the mutual fund managers in order to go out and take advantage of potential trading opportunities. Another measure is something called the on-balance volume. This is a momentum indicator that relates volume to price change. Again, it uses trading volume, and again, it uses that in addition to price and looks at the trading volume as a running total, right? So an up volume occurs when stocks close higher and it's added to a total return. The down volume occurs when, again, stocks close lower, and of course then the volume is subtracted from the running total. So the direction or trend of this summation, if you will, is important in understanding trends. So there's a bull market when this on-balance volume is increasing. That means typically prices are moving higher and volume is increasing. So that gives us then this indication that more people are buying than are selling. Another measure that's we'll actually look at this in a research project is something called the relative strength index. It measures a security's strength of its advances and declines. And again, this indicates momentum. It's usually best if you talk about pretty short time periods, and it helps to identify market extremes. So again, typically this RSI ranges from 0 to 100, but most of the time it's going to be between 30 and 70. So investors are going to set buy and sell ranges, right? And then when you approach those buy and sell ranges, that's going to trigger a trade. So this again is going to help by signaling whether the prices are moving to the top, whether it's moving to the high prices, or whether it's moving to a lower price. And of course, as it moves to its lower price, the expectation is that maybe it's getting to the bottom, and now it's a time to buy. Now, one of the tools that we can use is something called charting. And again, this is where we're looking for trends in prices. And again, we use this information when we're looking at individual specific stocks to try to predict where we think things are moving. And what we create through this are what are referred to as lines of resistance or lines of support. So a line of resistance is when a stock price breaks through this line of resistance. That is a buy signal. And when it breaks through the line of support, that's at the lower level, that is then a sell signal. So if you look here, we see in this very first thing, we have a resistance level at the top. You see prices, they can do a little horizontal line. Here's none of the prices seem to be falling below this. Now when it breaks above the resistance level, you buy. When it breaks below the support line, that's when you're going to sell. So again, depending on the pattern, you can say they all have kinds of fancy names. These are just relationships that we look at for prices that maybe tell us when it's a good time to invest in stocks. One of the tools that we use along with these patterns that we look at is something referred to as moving averages. And typically, these are calculated in 10 to 20 day segments. Using a 50-day and a 200-day moving average are two lines that are used quite frequently in trying to look at, again, when is a good time to buy or sell. So a buy signal is when the stock price moves above one of these moving average lines. And of course, a sell signal is the exact opposite. So if we look here, we see that the red line here is the 100-day moving average. So right here where it goes below, right, we reach to the top here, and then all of a sudden the stock drops below the moving average. This is where you would want to sell, and when it goes to above it, that's when you'd want to buy. And again, if we bought here, we would get this entire movement till finally, oh, there it goes, it drops below again, so then we would sell, right? So again, this pricing or charting is just a picture that from the picture, we're going to try to estimate what we think is going to happen in the future. Now this comes from what's referred to as big charts. And again, you can see that this typically gives us a couple of things here. Here's the moving average. One of these is the moving average, right? That's this smooth line here within the pricing things. Down below here is the S&P, this is the S&P 500. And this is actually a picture of Disney. This is the relative strength index. And if you can look here, you can see that relatively here of the last April through May, relatively the relative strength index was rising, but now it's on the downturn. So what happens? This might be individually, I might say, look, if this goes below 45, I want to sell this thing because it's really losing its relative price growth, if you will. So I might want to sell at that point. Again, I'm not an expert in the charting and technical analysis field, but in general, these are just pictures, right, that people would utilize to give them a sign, if you will, of when they might want to take an action. So that's the end of our videos on market efficiency and behavioral finance.